What should you do if paying taxes on your Roth conversion generates more in taxes? Now, we've covered numerous times on our Safeguard Wealth Management YouTube channel different ways that you can pay your Roth conversion taxes. You can pay your taxes right out of that given conversion. Now, generally, the most optimal way to pay your Roth conversion taxes is paying out of your taxable account. But what happens when you've been investing that taxable account, and now in order to take money from that taxable account, we need to generate a taxable event? We have unrealized gains that when we sell, we're going to generate more in taxes. How does that change the break even between paying out of your taxable account, and does paying out of your taxable account still remain the most optimal situation for your retirement? Well, in today's video, we're going to be finding the sweet spot around paying your Roth conversion taxes and analyzing if paying your Roth conversion taxes out of your taxable account still makes sense if you have to generate more in taxes to do so. Generally, paying taxes out of your taxable account is the most optimal situation. The reason being is because your taxable account is a less tax advantaged account. Anytime that you make a change within that account moving forward in the future, anytime you have a dividend or turnover within that account, it generates a taxable event, which you now owe taxes on. And so essentially what you're doing when you're paying taxes out of your taxable account is you're moving money from a less tax preference account and moving it into a more tax preference account, a Roth IRA. So in a previous video, we explained this spreadsheet right here, where we showed two different scenarios. Scenario one is essentially paying taxes out of your Roth conversion. So you perform a $100,000 Roth conversion, taxes are $22,000, and so only $78,000 ends up within your Roth IRA. And we see it growing through time, and we see your taxable account that's left untouched is also growing through time. And so in the final period here, we basically look at after-tax amounts. Now we're going to compare this to scenario two here, paying taxes out of your taxable account. And so now your taxable account essentially is exhausted here. The full Roth conversion, that full $100,000 Roth conversion, ends up within your Roth IRA and grows unencumbered through time, and it's already translated to your after-tax amount. And so when we compare at the end of these given periods, these after-tax values, we see that there is quite an added benefit to paying taxes out of your taxable account. We looked at basically being able to withdraw this $22,000 from your taxable account and having it not generate any taxable gain, as if you were taking $22,000 in cash from your taxable account. But what happens when taking money from your taxable account generates more in taxes? What this would look like is, let's say we're initiating a $50,000 conversion. Taxes here are going to be, let's say, $11,000. And so again, we could hold it right out of our conversion, but we also have a taxable account on the outside here. The problem is with this taxable account is we have unrealized growth in this taxable account of $37,000. This taxable account is worth $120,000. And so to withdraw $11,000 from this taxable account, we're actually going to have to withdraw a little bit more than $11,000, because we're going to have to sell out of some of these unrealized gains. That's going to generate some long-term capital gains, which is going to generate some additional tax. And so we're going to have to pull more than $11,000 from this taxable account. Does this completely ruin the value of paying taxes out of our taxable account? In this type of situation, would we now be better off paying taxes out of our conversion? Well, as with most things in retirement, this is a layered retirement decision. Just like a forward-looking tax plan is a layered decision. For instance, it may look like it doesn't make sense in 2022 to max out the 22% or even max out the 24% bracket, because after all, in doing so and performing a conversion and maxing out those given brackets, we are generating more in tax this year. And so paying more in taxes never looks like a good decision on the surface. And so when we wrap this into a forward-looking tax plan and we see that maxing out the 22% or the 24% bracket this year avoids being taxed at, let's say, the 33% bracket down the road, now all of a sudden a conversion this year starts to make sense because we're eliminating future taxes into higher brackets. And so most decisions in retirement are layered. They start looking significantly more complex as we start fine-tuning variables. Well, paying taxes out of our taxable account is a very layered retirement decision. For instance, on the outside layer, we may just look at the tax consequence of paying out of our taxable account. And now we may completely throw out this given idea because, again, at the end of the day, we don't want to generate even more in taxes. We're already generating taxes because we're doing a conversion. Well, let's go another layer deeper. What about the tax drag of our taxable account? So looking at the future growth from our taxable account, we know that anytime that taxable account generates a taxable event, it is decreasing the future value of that given account because we're paying taxes and reinvesting that money. And so we're hampering the future growth. This is something called tax drag. It comes in the form of dividend tax drag or turnover tax drag. We also have to be looking at the current long-term capital gain rate that we'd be paying today by paying taxes out of that taxable account versus the future long-term capital gains rate we would be paying. So for instance, if we're paying a higher rate today on the taxes from the taxable account versus what we could realize at a lower rate in the future, that may also either increase or decrease the value of paying taxes out of a given source. You can also look at the liquidation value versus the step up in basis value. And what I mean here, liquidation value essentially means that throughout your retirement, you're going to be taking money from this taxable account, taking income from that taxable account, liquidating the unrealized gains within that taxable account because you're going to be using that within your tax efficient withdrawal strategy. Versus a different lens to look at would be if you're not going to be using any of that taxable account throughout your life and instead you're using that as an estate planning tool. You're planning on passing that on to the next generation, and then they will receive a step up in basis. And so at each layer, we see that certain variables can completely change the given dynamics of what is optimal, paying out of the conversion or paying out of your taxable account. And so let's start walking through some of those layers. The complexity is going to grow as we add additional variables and additional considerations. That's completely fine. Again, when we're retirement planning, we want to be looking at all of these complexities, all of these given variables, so we can ultimately make the best decision for our retirement. If we're just looking at the first layer deep, we may be making the wrong decision for our situation. And so again, I'm going to be looking at a few different scenarios here and changing variables and showing how it translates to what is more optimal, paying taxes out of the conversion or paying taxes out of your taxable account. And so there are going to be a few things that are consistent through all of these given scenarios that I'm going to show. We're going to be using a $100,000 conversion, and we're going to be using a $100,000 taxable account. We're going to be showing a 20-year time frame here. So we're going to be showing the end value of these two accounts, of these two strategies moving through time, but at the end of a 20-year time frame. So for instance, in the case of paying taxes out of the conversion, we're essentially going to look at a Roth conversion that ends up with a little bit less within the Roth IRA because we paid taxes out of the conversion. And we're going to be looking at a full taxable account and basically looking at those moving through time. Then at the end of this given 20-year time period, we're going to add those two accounts together in the form of after-tax value and look at that versus paying taxes out of our taxable account. Again, we'd end up with more in our Roth IRA, a little bit less in our taxable account, but again, looking at those moving through time. Now on the left-hand side of the screen here, you're going to see a chart. In each of these scenarios, you're going to see the same given chart. I try to show as many variables as possible so that we can completely understand all of the things that are going on. Now I'm trying to show this first scenario so that we have a baseline here. Now in this baseline example, I'm looking at liquidation value. So what I mean again by this liquidation value is at some point throughout our retirement, we're going to be looking at using this taxable account for income. So any unrealized gains that we accumulate within this taxable account, we're going to have to end up translating that to after-tax wealth. Second, in this baseline scenario, we're going to be looking at unrealized gain percentage being 25%. So let's say that we're taking $20,000 from our taxable account in order to pay the Roth conversion taxes. Well, in that given scenario, $5,000 of that would be unrealized gains that we are now realizing. And so we're going to have $5,000 that we're going to owe long-term capital gains on that is going to generate additional taxes. We're going to be looking at low tax drags as a baseline here. And what I mean by low tax drags, we're going to be looking at a dividend tax drag of 1% per year. And we're going to be looking at a turnover tax drag of 3% per year, meaning that in any given year, we're turning over 3% of this given account, either through mutual fund capital gain distributions or just natural rebalancing. We're also going to be looking in this baseline scenario at the current long-term capital gains rate being 15%, as well as a future long-term capital gain rate of being 15% as well. And so what we see basically here in this baseline situation is to pay taxes out of our taxable account, we're having to sell out of this taxable account and we're having to sell some unrealized gains, thus generating long-term capital gains on these unrealized gains and having to pay a little bit more in taxes. But nonetheless, when we look at this moving through time at the end of this 20-year time period, in after-tax dollars, if we pay taxes out of the given conversion, we're going to have $758,480 versus if we pay taxes out of the taxable account, we see that this is still the optimal scenario. Despite having to pay more in taxes, we have $770,752. Now let's start to change given variables. You'll notice that with every variable that I change, I'm going to bold what variable I actually change. And so in this scenario, everything is going to be the same as the last scenario with one key difference. Rather than full liquidation value, we're going to be looking at step up in basis value. So now we're looking at that taxable account, passing that on to the next generation. And so how does this change this given equation? What you'll notice is these two scenarios here get a lot closer. In terms of paying taxes out of our taxable account, we have almost $797,000 in this given scenario versus paying taxes out of our taxable account, we have $800,500. And so we see that we have a lot less upside when we're looking at passing this on to the next generation, or at least passing our taxable account on to the next generation. And again, this makes sense. The reason being is because when we're paying taxes out of our taxable account, we're generating taxable gains. Now that's money that would otherwise be passed on to the next generation pretty much tax-free, again, earning that step up in basis. So then this begs the question though, why isn't paying taxes out of the conversion a better choice? Well, it all comes down to tax drags. Even though we're passing on the unrealized gains to the next generation at a 0% rate because they're getting a step up in basis, as we're still alive because of these given tax drags, it ends up decreasing the value of that taxable account through time, and we end up having more value if we keep more of that money in that Roth conversion and pass on our Roth conversion to the next generation. Again, in both scenarios, they're tax-free, but it's the tax drag that decreases the value of that taxable account. Now, what happens if we have significantly more in unrealized gains as we're making these type of decisions? And so let's say this is a scenario where we started a taxable account when we were young, okay? And maybe we just dollar cost average into that account through our working career. We never really touched it outside of that. And so the $100,000 that we have in that given account, we have a cost basis of $20,000. And so we have $80,000 of unrealized gains. And so now when we sell out of our taxable account to pay our Roth conversion taxes, we're having to pay a lot more in long-term capital gains. We're having to pay a lot more in additional taxes. How does this change the given break-even analysis here? Now, it's important to note we went back to looking at liquidation value here. We're not looking at step up in basis. And so despite having a larger unrealized gain, we still see that this ends up being the optimal scenario versus paying taxes out of our given conversion. But what you'll notice is the gap once again shrinks here. Now, if we reverse this and we didn't look at liquidation value and rather looked at step up in basis value, what you would see now is that paying taxes out of the conversion ends up winning. And so again, as we start looking at the different layers of this given retirement decision, we see that the outcome completely changes. Now let's look at adjusting some more variables here. So it's very common that as we're performing large Roth conversions, specifically in the first couple of years while we're still underneath the Tax Cuts and Jobs Act, that we see conversions pushing us up into higher long-term capital gains rates. So it's important to understand in the eyes of the IRS how your income stacks. First, you have pension and Social Security, your guaranteed income. That stacks first. Next, you would have any IRA withdrawals or any Roth conversion. That stacks on second. And then finally on top, you would have your long-term capital gains. That stacks on last. And so we can see that as we're performing larger conversions, we're pushing our long-term capital gains into being taxed at higher rates here. So a very key one specifically for married couples is the net investment income tax. It's an added 3.8% long-term capital gains tax that is added on if you're married filing jointly and you show an AGI above $250,000. And so it's very common, as we show on the left-hand side of this screen here, where we're taking a very small snapshot of a forward-looking tax graph, we see that this person is maxing the 24% bracket, and thus their AGI is being pushed well above this net investment income tax. And so any long-term capital gains that is generated by paying taxes out of a taxable account is being taxed at 18.8%, whereas in the future it might be taxed at 15% or maybe even the 0% long-term capital gains bracket if we're able to keep our tax base low enough. And so how does paying a higher tax rate today versus what we can realize some of those unrealized gains at a future time period, how does that change this given break-even analysis? Well, as you'll see in bold, I'm changing once again a few variables here. So first off, what I'm changing is I'm raising the unrealized gain from 25% up to 35%. I'm changing today's long-term capital gain rate into being 18.8%. This person is doing a conversion where they're maxing out the 24% bracket. And so when they pay taxes out of their taxable account, they're going to owe a little bit more in taxes. And I'm also lowering the future long-term capital gain rate here. Now, there is no 10% long-term capital gain rate, but we're essentially looking at a prorated rate. And so there are going to be certain times in the future where this person is able to realize long-term capital gains in the 0% rate zone. There's also going to be certain times where this person has to realize long-term capital gains in the 15% zone. Prorated together, their long-term capital gain rate going forward in the future is going to be 10%. They're paying significantly more as a long-term capital gain rate if they pay taxes out of their taxable account today versus what they could realize moving forward in the future from that taxable account. Everything outside of this, we're looking at the same exact variables as the baseline. We're looking at liquidation value, we're looking at the same tax drags, and interestingly enough, even when we're paying a higher long-term capital gains rate today, we still see that paying out of our taxable account is still optimal. Again, a few reasons for this. One, once again, we're looking at liquidation value. We're also looking at tax drags moving through time that once again are hampering the growth that we're going to see out of that taxable account. And so despite taking the Roth conversion taxes out of our taxable account and paying a higher long-term capital gain rate to do so, we still see that, yes, the value of paying out of our taxable account has decreased slightly, but there still is a premium that we earn. Now, there has been a trend that you've been noticing throughout all of the scenarios that we've talked about thus far. We've still been including a tax drag. Now, a tax drag, once again, is generated when you have any dividend from that taxable account that you're taking that dividend. It's a forced withdrawal. You're paying taxes on that dividend and you're reinvesting that dividend. Same thing happens with turnover tax drag. So whether that's you changing up given investments in any given year, or whether that's you owning mutual funds that are pushing out a capital gain distribution at the end of the year, both of those translate to turnover tax drag. And any tax drag within your taxable account, you will see over time, will decrease the future value of that given taxable account. But what happens if we're able to eliminate tax drag? Well, how can we eliminate tax drag? Well, theoretically, we can do so by, let's say, investing in no dividend stocks or no dividend funds within our account. We also can never adjust things within our taxable account and thus decrease or completely eliminate that turnover tax drag. Another important understanding, though, for how tax drag is created. Tax drag is only created when you're taking money from that given account, you're paying taxes on it, and you're reinvesting it back into that taxable account. If you were taking, let's say, the dividend or turnover drag as income, now all of a sudden we've eliminated that given tax drag. And so what if you eliminate tax drag by taking it as income? So now, because we're taking the tax drag as income, we're taking money from that taxable account, we're going to show step up in value because we're assuming that we don't need any additional income from this account because we're taking that in the form of dividend as well as turnover drag. And so now we see that paying taxes out of the conversion finally starts to make more sense. Now, up to this point, I've showed a lot of scenarios where paying taxes out of the taxable account makes more sense. Doesn't mean that it always makes sense to pay taxes out of your taxable account. There are certain variables that if we change, if we adjust, it moves to paying taxes out of your conversion, making more sense. And so as you see through all of these given scenarios, we have to juggle a lot of variables. There are a lot of layers to this given decision. Let's talk through what some of those variables are just to recap this given concept and make sure that you're adequately weighing each of these variables as you start to make some of these decisions within your retirement. So let's jump into some of these variables. Your capital gain rate today versus the future capital gain rate. If you have Roth conversions that are pushing you up into that 18.8% zone, and at some point in the future you can realize at a lower rate, that is going to greatly decrease the value of paying taxes out of your taxable account. If you're using your taxable account for income inside of your tax efficient withdrawal strategy, or if you're leaving it to the next generation in terms of step up and basis, this is a very big variable. Depending on how high your tax drags are within your taxable account, that is another variable that hamper your future taxable account growth and make it so we want to pay taxes out of our taxable account because we want to decrease the money we have within that taxable account. Now, throughout these given scenarios we've shown thus far, we've just simply been showing a 20-year time horizon. But it should intuitively make sense that as we show a shorter time horizon or a further out time horizon, once again, it changes the dynamics of this given calculation. For instance, the longer our time horizon, the more tax drags will hamper our future performance. Versus, if we're paying a higher long-term capital gain rate today to do a conversion, and our time horizon is very short, well, we just sacrificed and paid a higher long-term capital gain rate than we otherwise would if we just waited another year or 2 years to realize some of those gains. Again, if we have a shorter time horizon, we're likely passing on more in the form of step up in basis as well. The percent of unrealized gains can also factor into this given equation. Another variable that we didn't discuss quite as much within each of these scenarios is constraints from our forward-looking tax plan. So let's say that we have a tax cliff that we are trying to stay under. Let's say we're using IRMA as that given tax cliff, meaning that we want to show a certain level of income in terms of our modified adjusted gross income, but we don't want to show anything over that given threshold because we will have a subsequent tax penalty for doing so. Then we can see if we're paying taxes out of our taxable account and thus generating some long-term capital gains, that is now decreasing the amount that we can end up converting. And so now that taxable event that comes from paying taxes out of our taxable account is now removing room for what we could otherwise Roth convert. Finally, rebalancing considerations. Let's say that you've owned a small cap growth fund within your taxable account for a few years. You started out at a 10% allocation within that small cap growth fund, but because of some substantial growth over the last 5-10 years, we've all of a sudden now seen that 10% allocation grow to 20% as an allocation. And so if we wanted to rebalance that taxable account, we would have to generate a tax event. And now we would have a tax drag. Well, if we're paying taxes out of our taxable account, we can strategically pick which assets we want to pay taxes out of. And so now we can use that paying taxes out of given assets to now maybe pay taxes out of that small cap growth fund, thus rebalancing that allocation back down to that initial 10% and hopefully optimizing our portfolio within that taxable account moving forward. And so we can offset some of that given tax drag by strategically selling out of given assets when we're paying those taxes out of our taxable account. Now, we covered a lot of ground here. We covered a lot of variables. We covered a lot of different layers as we talked through what are the optimal places to pay your Roth conversion taxes from. We can see that in the majority of the scenarios that we looked at, paying Roth conversion taxes out of your taxable account is still the most optimal. But again, we also showed scenarios where that's not the case. And so understanding your situation, understanding what's best for your forward-looking tax plan is the whole retirement game. It doesn't matter what is generally the most optimal. It matters what's the most optimal in your situation. If you'd like to see further analysis on this given topic, let us know in the comments below. Always remember that you don't need more money. You need a better plan. You need to make sure you're looking at all of the given layers when you're making any retirement decision within your retirement plan. If you like this video, please hit the like button down below. It'll help other retirees just like yourself find this video and hopefully gain some value from this video. And if you like this kind of content, hit the subscribe button down below. Please subscribe to our channel. We release videos on a weekly basis. You'll be notified of all future videos that we release. I want to thank you for taking time out of your day to improve your retirement. We look forward to seeing you in the next video.